Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Hello, welcome back to another episode of Broker Daily Uncut. I'm Julian Barnes. I've been away for the last couple of weeks, but I'm glad to be back. Back with Eva, back with Costa.
Good to have you back, Julian. Back to the usual suspects here today.
Yeah, absolutely. And I don't think much has happened since I was last here, right?
No, it's actually been quite quiet, so you left at a good time.
I left at a good time, absolutely. For work-wise, I was just on my phone going, oh, okay, right, let's just deal with that when I'm back, which we are now going to get into and we're now going to deal with. So I want to start quickly. Let's look at the auction clearance rates. Now, these are come in from Catality as usual. And, you know, each week I've been talking about it. I've seen them low, and there's always a different reason that we can kind of give, whether it be a bank holiday or an interest rate rise. But obviously now there is a new elephant in the room, so to speak. So this week it was the fifth time in the past 7 weeks that the early clearance rate held below the 60% mark, and the third lowest result for the year to date. Is this a bit of a buyer's market now that we're seeing?
Yeah, I think now
Definitely.
I think now you can call it. Yep.
Absolutely. And within that, how is that kind of changing the market as you're seeing for investors? Let's talk about the budget in a second, but are you seeing that funnel through in some ways?
I think there's still, and we've mentioned that a lot of the time in this podcast and others, there is different markets, right? And there's always the one that are falling a little bit behind. And I think if you actually go through the data and find the market within markets, there are still markets performing exceptionally well, especially in the regions. And I think Adelaide is picking back up as of last weekend. So it's, there's many speeds in the market. Yeah. But I guess where the prices are already unaffordable, that's where it's getting tricky.
Yeah,
that's
absolutely.
where the buyer's market are. But investors in those pool of market that are competitive, they're still struggling to find properties. So
yeah, absolutely. And obviously it did come out there that kind of Adelaide's doing a little bit better, gaining a bit of momentum. So 147 auctions went to market, a 41% jump on the previous week's volume. So you are seeing, as you say, some. But obviously, there is that big elephant in the room, which is that now we've had this budget, which is one of the biggest shake-ups we've seen in a long time for housing, for particularly on the investor side of how this is going to work. Obviously, I want to get into every part of this, as particularly for you too. In the investor kind of side of broking, you're seeing big changes for your customers, big changes for your clients. What was the initial impact? So obviously, this isn't necessarily a surprise. All of the things
Well,
that this
they'd
has been
leaked it a
talked
couple
to.
of weeks prior to sort of get everyone expecting it. So yeah, like you said, it wasn't a surprise. I think the reality of it is that they said they weren't going to do it, and they've done it. I think that's where everyone's sort of up in arms, because if you take it to an election, they then vote on it, and then I guess it is what it is in the end. Everyone accepts it. But because they said no, and then they brought it in, there's a big uproar, and it's just like people are just saying that it's not going to fix the housing situation, which I probably believe to be true. But here we are.
Yeah, absolutely. And obviously, that is kind of the second hurdle, right?
That's what I thought was very interesting is you said, budget, and all we talk about is the investment section of it, when really this budget was meant to help first-home buyers, right? And people getting into the market. We haven't had any news or commentary or actually first-home buyers saying, hey, awesome, this really is going to take us to buy anything. It's all been about, okay, well, you're doing this, but no one seems to react on that. Everyone seems to be like, well, it's actually going to have a lot of consequences. It's going to be changing a lot, but not for the first-home buyers. It's more for the investors and
well, if you're a first-home buyer, as they're saying, it's for the first-home buyer who want to buy the newly established houses, apartment blocks, and all that sort of stuff. But they allow you to negatively gear new builds.
That's right.
So if first-home buyers are buying these properties, and you're trying to make it easier for them, why are you now telling every investor that wants to negatively gear a property, hey, you can't buy existing stock, go buy the new stock where the first home buyers are?
Yeah,
just don't
absolutely.
get it.
And
It just
you also
doesn't
see
make sense.
incentives in that regard
It's
as well.
to push supply and builds as well,
Yeah.
but it's creating, again,
But the
more
underlying issue
competition.
with supply isn't to a point that there's no buy, it's that so much government red tape that it is just absurd. Construction costs are skyrocketing. You need to fix the fundamentals before you're going to do anything else, because in the end, you may have more buyers that are going to buy properties because you can negatively gear them. But in the end, if a builder can't get a property or a development to add up, they're not building regardless if there's 200 or 500 people waiting to purchase.
Yeah.
Just the numbers need to work before you even dig.
Well, I want to put this to you. So this is a quote from the Treasurer, Jim Chalmers. These changes will level the playing field for workers and first home buyers and support investment in productive assets, including new housing supply. What do you think about that? Do you see this as being able to stimulate? Because as you say, it seems very kind of demand side, focusing specifically on investors, potentially trying to kind of taper that price increase rather than having real meat for kind of first home buyers here. Obviously there has been, and they've said it will continue these different initiatives and schemes to try and get in. And I've seen some stateside things. I think in the WA state budget they increased the stamp duty exemption by 100 grand.
For new build home.
Yeah. So for new and extra
but again,
for new builds, which
that
is obviously
helps
where
developers go, all right, I don't have to pay that tax anymore. So that means more money in their pocket, and it allows them to make that development stack up. If you're not doing things like that make it easier for a developer to build, it's just all commentary in the end. It's not gonna do it.
Yeah. It's all about demand and supply, right? It's
Well, the demand's always been there.
It's
It's been like that for 20 years.
But it will change demand, I think. So you might see, obviously, it doesn't apply to the home you live in, right? So you might see people, but at least your mum and dad investors say, well, instead of buying a second property, I'm going to look at upscale, going up the property ladder, buying a more expensive property for myself. So then, we're going to be able to invest in that regards. Mm-hmm. Obviously, I think you said commercial is not included. So we might see some, is that in negative gearing? Is that correct?
Yeah, negative gearing. There would be a lot of new vehicles being thought of to invest and find ways around it. But I think what's really, I guess, annoyed me in that budget is that people and the younger generation that are looking at to buy their first home. On the one, maybe they have understood how to create wealth, but the one who do, and we're thinking, you know what, I'm just going to rent where I want to live and invest and reinvest, as we call it, and try to build wealth and help my kids later on, and all these things that this generation has been able to do, or boomers as they say. That's gone, right? And they're saying, well, yeah, you can still do it if you buy a new home, and help the supply going up and that. But that's not how people want to do it.
Don't stack up a lot of the time on those new builds
as well, and it doesn't grow as well, and it doesn't.
And that's why a lot of investors do stay away from those new builds, because the numbers just don't add up. Like, you're going to be paying over $2,000 in strata fees. Like, who wants to do that? Like,
absolutely. And obviously capital gains now applies to kind of stocks, shares. So you may those kind of avenues of what we'd typically say is responsible investment, looking at ways to grow your wealth.
That's it, and that's
being punished.
And so all those Gen Z or whatever, how do you build wealth now? Like, that's the question I have.
Well, the younger generation were the biggest investors in ETFs, and a lot of them would put their money in ETFs because it's a very very low entry point. And then after a while, they'll then extract that out to put down for a deposit for a home. Yeah. And they can still do that, of course, but now you're going to be taxed like no tomorrow on it. And it doesn't, as much as they say it helps, I just can't see how it does.
Absolutely. Well, even Costa, I want to talk to you because obviously you're seeing kind of the blunt end of this. And I want to ask you, so obviously based on the two main headlines here, which is obviously CGT discount changes and negative gearing, what are you seeing from your investors in terms of how that's going to change their behavior specifically?
Yeah, so I think every broker should really check their client's pre-approval. Mm-hmm. Yeah. A lot of them are worth nothing now. Like,
Right.
if you had a pre-approval for 500,000, thanks
Well, you got
to
Macquarie that
negative
came out
gearing,
as well this
thanks to negative gearing, that's dead. Like, forget about it unless you go and buy that brand new property. I had actually myself submitted a pre-approval for 1.7 million last Thursday, thinking, nothing's been, goes through, it's fine with Macquarie. Macquarie came back, said, hey, look, it looks fine yesterday. Today with no negative gearing, it's 1.26, I think.
Wow.
A huge difference.
Yeah.
So I called my client and I explained, and they're like, well, what's going on? Like, it's $100,000 less. I'm like, well, that's the effect of negative gearing. So there's also, I think, all of this has been planned without really thinking, well, that will affect investors in terms of tax benefit. But what about servicing? I don't think they went that far into thinking, well, they actually can't even buy properties anymore.
Yeah, absolutely. Yeah. And I want to take a quick break there. And after the break, maybe we'll get into a bit of that kind of topics around servicing and that. See you in a sec. Welcome back to Broker Daily Uncut. Now, before the break, we were talking obviously about the budgets and the repercussions. But now I want to dive a bit further into how it's going to affect servicing, how it's going to affect investor behavior, investor strategy. So let's get into that a bit. So I think the first bank to come out and say that they've recalculated the way they're going to be, they're going to calculate their servicing has been Macquarie Bank, correct?
Correct.
So
and I think Westpac as well came out of.
Westpac, I think as well. They didn't confirm it to Broker Daily specifically, but I think they've been talking with brokers.
It's going to happen.
Obviously, they're all going to go, right? Like this is a material change.
Yeah, but it hasn't happened yet, right?
Yeah, the policy actually hasn't been hasn't passed yet.
Yeah.
Why do you think they're biding their time there? Because obviously
they know
matters.
it's going to go through.
Yeah.
I think they don't want people to be caught as well of buying a property knowing that they wouldn't actually be able to hold it if they don't get that little bit of cash back.
Yeah.
At tax time, which could put people in.
Yeah, no.
Yeah.
But right, so Macquarie Bank, though, it's the first major lender. It strips most negative gearing tax benefits from the investor loan calculators after the government kind of limited it to just new builds, as we've just said. For years, it's kind of treated those expected tax refunds from negatively geared properties as extra income, boosting how much kind of investors borrow. But now with those disappearing, obviously banks are going to be removing that. So let's talk. Firstly, you said before, I think, what was it, 1.7 mil going down to 1.26?
Yeah.
Is that extreme, or is that kind of the going rate?
Well, obviously, it's proportional to the loan size. So the bigger you're going for, the bigger the hit's going to be on your negative gearing. So I think, I was looking a little bit at my pre-approval book. People that have had pre-approval around the $500,000 mark because they were tight on servicing, those people are the one I have to call and say, I'm sorry, but unless you buy something new, it's not happening for you.
Wow, yeah. This is a massive change. Do you think that is changing the investor proposition substantively?
It's definitely going to change the mindset of them. I had a new client yesterday. What they wanted to do, took off negatively gearing, just over 200,000 that in service. So I had to think outside the box a little bit. We've now got to start considering, I think the people that are going to benefit most from this will be second tier lenders.
Yeah.
Because they've got high borrowing capacities. Listen, they do offer a higher interest rate, a little bit higher, but in the end, they're allowing the clients to still purchase the property. So we're now taking that client to a second tier lender. We originally would have been able to take them to any of the major banks. They're now all out of the question. So, I just think it's going to be different the way we service people now. I think prices may come down as well in this because people won't be able to purchase at these amounts. So I just think purchase prices will come down with what they want to buy. Second-tier lenders will start playing a bigger role. And also SMSF, because that hasn't been touched.
Correct.
Yeah, absolutely.
And I've had a couple of clients actually start considering SMSF. So that space is going to be booming, I reckon.
It was already doing all right.
I was going to say it's already doing
it.
It's on the up and up as each month goes on. So I think there'll be probably
that, and we see the capital gain tax in super
100%,
extremely generous. So
well, when you retire,
there's nothing. So
there's nothing. Yeah, so building that as much as possible,
Yeah.
right? For the long haul is definitely going to be a strategy. What about the kind of types of properties? Do you think that's going to change? Because obviously, as we noted, the negative gearing changes don't apply to new builds. But then at the same time, as you said, they haven't been traditionally as attractive for investors for a variety of kind of material reasons. Do you think that that's going to be an area that investors are going to be looking at more, as well as also commercial property? Is it going to kind of, maybe demand will still be there? It's just going to move as to what kind of properties they're going to want to buy?
Yeah, I think it's going to be some of that. So there's always, there's different type of new build. There would be like, an off the plan 1 unit within a $2,000 unit block. Probably not ideal, but if you buy brand new, standalone property, that could be all right.
Yeah.
You're always going to pay a premium. It's always going to grow less or less quickly. I guess historically that's what's happened.
Yeah,
who knows? It might change as well.
Yeah.
You never know.
Yeah.
But that's probably where they're going to go if they really want to keep buying residential property, and they have no other choice because servicing doesn't work and commercial is completely exempt. So if you've got the cash flow for that.
Yeah, but commercial, you're dealing with much lower LVRs.
Yeah.
So I think the potential to purchase commercial is going to be much harder. Like you're looking at 70 to 60% LVRs. So the big, massive cash outlay where but it's going to be possible for some people and they'll start considering it. So I think a bit of everything. Some people are going to stay with older properties. There will be people that move to newer properties, and there will be people that move into commercial properties.
Yeah, and buying through companies probably.
Yeah,
instead of
100%.
Yeah, of course. Yeah, that's going to be another avenue. And I want to ask, on the back of that, obviously, kind of we've seen the investor category kind of broaden so much from, young people, mum and dad investors, right through to your kind of seasoned investor investing millions in all kinds of different properties. Where do you think this will hit the most? And from a broker's perspective as well, do you think this could impact kind of who is entering the kind of investment space? Does it make it more difficult? Does it, complicate things, or does it potentially make it easier? Where does it sit there?
I think it will discourage a lot of the mum and dad and investor, the one that are buying 1-2 properties to try to get ahead a little bit. And some of them do need the negative gearing to help holding that property. Really, they do say that's just a bonus, and you shouldn't be investing for tax benefit. And it should always be about how much gain you make at the end,
like a material thing.
Yeah, and it's true, right? But a lot of those mom and dad investors cannot hold a property for like 10 years plus without a bit of the help there.
Yeah.
And really, it's a business, right? You invest in property, you should be able to.
Yeah, absolutely.
Yeah, well, it goes. You should be able to get the negative. You should be able to negatively gear it, because if you don't, what happens? You try to make the money up for rent increases. And I think that's going to be another sort of segment of the market that's going to be hit hard, is because, well, if I can't negatively gear this house anymore, I need to make up that money. Well, when you have a property, where do you make it up from? Charging more for tenants. So
especially with the 3
could be
hikes we've just had.
So we might see, rather than making it kind of easier for renters, we might see, firstly, a sell-off of properties as people who I don't want to be involved with. Secondly, an increase in rents.
Well, I said it on last week's podcast. In 1985, they got rid of negatively gearing. Rent skyrocketed in Sydney. And then in 87, they got rid of it because of that issue. So I don't see why that would be any different. If anything, it'll probably be worse now because the population's greater. We've got a massive undersupply of properties, and we've got a massive amount of people coming into the country. So it's there to
that's going to be really
seen.
tough. And obviously they said, one of the government would say that one of their strategies is let's get more people into home ownership. And they've pulled this figure of 75,000 people that are going to, benefit from a new home from this. I'm not 100% sure where they got that figure from, but that's the figure
also,
that they've said.
What's the immigration number?
That's the thing.
It's a lot more than 75,000.
And they're often the people, they are the people that are going to be pushing in straight into the rental market.
That's right.
They're not going to buy.
And they all don't want to live in, like, the main houses that are being built, obviously on the outskirts of the cities. They don't want to live there. They want to live where the work and all that sort of stuff is. So, yeah.
It's complex a complex issue.
It's an incredibly complex issue. And I guess
we don't have the answer for it.
From a journalist perspective, it's very interesting and it's very exciting to see what kind of where, big policy decisions, where it takes us. From a kind of broker perspective,
I reckon we should
or an
bookmark
investor
this
perspective.
episode and see what happens a year later.
Yeah, exactly. Well, I look forward to seeing where it goes. We better take a quick break there, guys. Back in a sec. Welcome back to Broker Daily Uncut. Now, as always in our final section, we like to look a little bit at policy, a little bit what's changing. Obviously, we just talked a little bit on Macquarie, but some of the kind of more kind of average policies that are coming through. Now, St. George have done a few little things here that I want to unpack. Costa, do you want to just kind of run me through this?
Yeah, St. George. For emergency service workers, 100% of eligible non-based income accepted with minimum 6 months year-to-date verification. So overtime and stuff like that, they'll now take 100% of that as long as you've been earning it for 6 months. And
it was 80 before, yeah?
Sorry?
Was 80 before?
It was shaded to 80.
80,
correct,
yeah.
So that helps.
And midwives are now added to the list of eligible
And is that, is that just a bit of CSR there, or is it?
I think it's good because it's allowing you to use more of the income to servicing. It's bringing midwives into play now as well, so they will be able to get their servicing up. It's not going to change the game, I guess you can say, but it's going to allow them to get more servicing.
It will bring more servicing, and it's something that we, have talked about on this podcast many times, that as servicing gets eroded, we're kind of seeing banks kind of looking, okay, well, where are the kind of responsible ways that we can find to
and emergency
give some back,
services is a very large. There's a lot of profession in that,
sure.
And when you look at the moment that investors, often there's one there that will qualify for that. So it does help servicing.
Yeah, no, 100%.
I think it's a good one.
And obviously they not typically, but often would have some kinds of, less normal cadence of pay or not necessarily just PYAG, which is another reason to get it in.
And they're also increasing their LVRs for vacant land to 95%. So as long as it's less than 50 hectares, which pretty much is the majority of Australia.
It'd be sweet if you both.
And again, it's. I think we've spoken a lot of times on the podcast where they're trying. LVRs are slowly creeping up for a lot of things, and I think that's because deposits are becoming harder and harder to come by. So they're increasing those LVRs, so that your deposit, you're not as deposit constrained. So there are a lot of things lenders are doing to sort of combat the deposit type constraints people.
Yeah, so you're kind of seeing those two kind of things, servicing and deposits, as both of those kind of, we're seeing that there. And an AMP bank has also kind of changed. So what is it? Up to 95% LVR loans and up to 90% LVR interest only for eligible customers. What do we know what that was before? Just a shade lower?
Yeah, you got 90 for most lenders, and Westpac St. George came up with the 95%.
Yeah, that was
not long ago.
A few weeks ago.
Yeah, which is great. It does help with, as you said, deposit restraint. The issue is it's still not helping servicing.
Yeah.
So with the hikes, with what's happening now with negative gearing, that what is going to replace that? At this stage, we've got nothing.
Absolutely, and as we said, that with the banks, that is one part of it, but it's we've just seen, while I've been away, we've seen yet another hike, and I know at the very least that NAB is forecasting one more in June. I don't know. Do you know what the other banks are saying right now?
CBA and ANZ reviewed their forecast saying no more. And Westpac still saying we could see a few. Yeah. It's changing all the time, though. I don't know what you...
It's crazy. I don't know where to stand. So I was in a NAB webinar just the other day, and Sally Old, their chief economist, she was saying that, one of the NAB's business customers was asking, do you think the RBA's made a policy mistake? She said, I think they made a policy mistake a couple of years ago when they cut the rates too soon, and now they're chasing their tails trying to move forward. And that was one of the reasons they said, they think that the RBA is still behind, that they feel still behind, so therefore there will be another rate hike, and if there is going to be one, it'll be sooner rather than later to try and catch up.
Makes sense.
And obviously that's going to...
Unfortunately.
We'll see. Yeah. I mean, hopefully...
hopefully Commonwealth Bank are the ones who win this one.
I feel like the next rate decision will be interesting. Obviously, there's a bit of time between now and then. There's going to be an inflation reading.
I think that will determine what they do.
Yeah.
And if it goes up, I pretty much guarantee that rates will go up.
This one feels different because the last one, it felt like most people were pretty resigned to it. That it was going to happen. I remember the banks moving quite quickly in terms of their fixed rates. This one could go either way. Obviously, as we said, there was a lot of stuff that could, crystallize the future a little bit more. But we'll see, I guess.
Yeah, I mean, the budget had so much spending in there.
Yeah.
So I don't know how that's going to help.
I don't think it's the everyday person who's spending all the money. But
Yeah.
Well, and then obviously, of course, the fuel shock kind of continues.
Well, that's it. There's so much more than just what's happening here.
Yeah, the fuel shock will continue, and obviously that's really laying on to businesses. Again, on the business side, and it was in this NAB webinar, there was quite a worrying sign of how much kind of input costs for businesses have moved up and how little margins they have to absorb that, which basically means that prices are going to go up. And the RBA is going to be looking at that.
Going back to construction again. Like construction costs have skyrocketed.
It's funny you say because construction was the worst affected segment of the market that
basically
NAB
all
found.
of construction has like some sort of petroleum or something in it. Like it's just materials. It's just absurd. So we need to fix the problem before we do anything.
Linking it back right to the beginning, that's going to feed on to building new homes, to the costs surrounding that part of the market as well, which obviously is going to be a hotter market given the way that
just ask us, we've got it all sorted.
Maybe we should go to the next Treasury meeting.
hopefully they're listening. Well, no, what an incredibly interesting conversation. Opening something up here, which I believe we will be talking about for many, many weeks to come. The impacts of the budget, I think, will be felt for quite some time. And it's anyone's guess to see how kind of things, I think even Gin Chalmers would accept that it's anyone's guess to see where it's going to go next. But thank you guys, as always.
Thank you.
For joining me. If people want to find out a little bit more about Finni, where can they go?
Finni.com.au. There's a tab there to book a call as well. If you just want to discuss, what's going on, or if you need to actually organise finance, we can help.
Ideal. And as always, if you want to hear more from us at Broker Daily, you can go to brokerdaily.au. That's all for now. Thanks very much and goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.